Rule 7. Invest only on a cash basis. When someone goes completely broke, it's almost always because he was operating with borrowed money, even someone who was quite rich. Using borrowed money increases the size of a purchase and thus increases the potential profit from a speculation or a business deal. If the investment does well, you earn profits not only on the money you invested, but also on the money you borrowed. By borrowing enough to double your purchase, you approximately double the profit you will earn if the investment does well. But you also double the loss if the investment does poorly. 1. When you see a golden opportunity, it's natural to get carried away with how much you'll make if everything goes well. So borrowing money to increase the size of your stake can seem like a smart way to exploit the opportunity. But no investment is foolproof. Its outcome will depend on far more factors than you or anyone else can identify. People you've never heard of will make decisions to buy or sell that will push your investment toward success or failure. Borrowed money can just as easily enlarge your loss as increase your profit. Think and go broke. From time to time, you hear about a billionaire going broke. And the news can be disheartening. After all, if such a person with access to the most expensive advice in the world can lose everything, it's easy to believe your chances of staying afloat are pretty slim. But the billionaire didn't fail because he received a bad forecast, lacked access to the right kind of information, picked the wrong person to manage his money, or chose a poor investment. Any of those things might hurt. But what sends a billionaire to the poorhouse is his rejection of common sense. 1. Because you have to pay interest on the borrowed money, your actual profit will be a bit less than double what it would have been without borrowing. Or your loss will be a bit more than double that of a cash investment. Rule 7. Invest only on a cash basis. 21. Almost always the immediate problem is borrowed money. For example, a mega-millionaire decides to build an office complex. He may put up many millions of his own dollars, but then he'll borrow an amount 5 to 10 times greater than that. The investment does poorly, losing perhaps a third of its original cost. The value of the property sinks below the size of the loan, which must be repaid. There isn't enough left in the business to cover it. The mega-millionaire has to reach into his personal wealth to make up the difference between the money he borrowed and the remaining value of the business, and has wiped out. Had he exercised the same prudence he probably applies in other areas of his life, he wouldn't have gone overboard betting borrowed money on the outlook for a specific speculation. On a smaller scale, similar problems can occur when an investor buys what looks like a high-potential stock or commodity and buys even more by borrowing money from the broker margin buying. High-potential speculations also can be high-potential losers. The price can drop so suddenly that the loss is greater than the amount invested, requiring that the investor cough up additional money, perhaps a lot of money. You can avoid this kind of fate. Investing on a cash basis doesn't insure you against loss, but it effectively eliminates the risk of losing everything, because investment prices rarely go to zero. And if you diversify not just among stocks, but across investment markets, even a severe loss in one market can be offset, or even overshadowed, by profits in another. 2. In your personal life, you know that debt can be dangerous, that it is better to earn interest than pay it, that it's easy to get in trouble once you start borrowing. The investment world is no different. Handle your business and investment affairs on a cash basis, and it's virtually impossible to lose everything no matter what might happen in the world. Especially if you follow the other rules in this book. 2. Employing diversification profitably is covered by Rule 11 on page 26. 22. Rule 8. Make your own decisions. Many individuals have lost their fortunes because they gave someone, usually a financial advisor or attorney, the authority to make their decisions and handle their money. The advisor may have taken too many chances, been dishonest, or simply been incompetent. Even when there is no wrongdoing, no advisor can be expected to treat your wealth with the same respect you give to it. You don't need a money manager. Investing is complicated and difficult only if you're trying to speculate and beat the market. To keep what you have requires only a simple understanding of the basics of investing. You can set up a right-proof portfolio for yourself in one day, and thereafter you need only 1 day a year to monitor it. Setting up such a portfolio for yourself is safer than turning your decisions over to anyone, even to the smartest person in the world. Above all, never give anyone signature authority over money that's precious to you. If you ever put money into an account for someone else to manage, it must be money you can afford to lose, and you must have written verification that you are liable for no more than the money you've already given to the manager. 3. You have no way of knowing what a money manager may be prompted to do someday by circumstances you know nothing about, his own financial problems, the pressure to keep his performance record competitive, or even problems that aren't related to his work but that impair his decision-making. Once you accept that all the decisions are yours to make, you can entertain anyone's advice through newsletters, personal consultations, books, whatever. These sources may help you clarify your own thinking, your own goals, and your own strategy. 3. Signature authority means giving someone the legal authority to make financial transactions on your behalf without having your signature on each transaction. Rule 8. Make your own decisions. 23. But if you expect someone to make the right decisions for you, you're in trouble. No one, not even I, will ever treat your money with the same care you will. 24. Rule 9. Do only what you understand. Don't ever undertake an investment, a speculation, or an investment program that you don't understand. If you do, you later may discover risks you hadn't been aware of, or the risks may find you. You might even discover that your losses are greater than the amount you thought you were investing. It doesn't matter whether your favorite investment advisor, your best friend, or your brother-in-law understands the investment perfectly. It isn't his money. He may be able to handle risks you can't, or he may know how to exit the investment at the right time. Because he isn't you, his understanding and judgment won't protect you. It's better to leave your money in a bank savings account than to sail into waters that for you are uncharted, where you don't even know what the potential losses might be. Someday you might understand a particular investment well enough to know whether it's right for you. But until you do, it's better to leave it alone. No complicated investment is essential for safety and security. As well as C, you can construct a simple portfolio on your own that will take care of you in any economic environment. You don't have to rely on something you don't understand. 25. Rule 10. Spread the risk. Every investment has its time in the sun and its moment of shame. Bullet. Precious metals ruled the roost in the 1970s, while stocks and bonds were in disgrace. Bullet. Gold and silver became the losers of the 1980s, while stocks and bonds multiplied their value. Bullet. Real estate was a big winner in the 1970s, but lost its luster when the tax rules changed in 1986. No one investment is good for all times. Even U.S. Treasury bills can lose real value during times of inflation. We've seen, too, that you can't rely on any institution to protect your wealth for you. Old-line banks have failed, pension funds have come under a cloud of suspicion, and scandals both real and imagined are common on Wall Street. The company you depend on to keep your wealth may no longer be the when you're ready to withdraw your life savings. Nor can you depend on any advisor to steer you safely from one investment to another as the economic winds change. Despite all the amazing track records you read about, no one can guarantee that he'll be right when your money is on the line. when you depend upon one investment, one institution, or one person to see you through. You must constantly worry that your one source of security might fail. But when you diversify across investments and institutions and keep things simple enough to manage yourself, you can relax, knowing that no one event can do you in. 26. Rule 11. Build a bulletproof portfolio for protection. For the money you're counting on to take care of you for the rest of your life, set up a simple, balanced, diversified portfolio. For the portfolio should assure that your wealth will survive any event, including events that would be devastating to any one investment. In other words, this portfolio should protect you no matter what the future brings. It isn't difficult or complicated to build a bulletproof portfolio. You can achieve a great deal of protection with a surprisingly simple mix of investments. The 3 absolute requirements for such a portfolio are: 1. Safety. It should protect you against every possible economic future. You should profit during times of normal prosperity, but you also should be safe and perhaps even profit during bad times, inflation, recession, or even depression. 2. Stability. Whatever economic climate arrives, the portfolio's performance should be so steady that you won't wonder whether the portfolio needs to be changed. Even in the worst possible circumstances, the portfolio's value should drop no more than slightly so that you won't panic and abandon it. This stability also permits you to turn your attention away from your investments, confident that your portfolio will protect you in any circumstance. 3. Simplicity. The portfolio should be so easy to maintain and require so little of your time that you will never be tempted to look for something that seems simpler but is less safe. I call such a portfolio the permanent portfolio, because once you set it up, you never need to reconsider the investment mix even if your outlook for the future changes. You leave it alone to hold the same investments, in the same proportions, permanently. You don't change the proportions as you, your friends, or investment gurus change their minds about the future. For a portfolio is a collection of investments you hold. Rule 11. Build a bulletproof portfolio for protection. 27. 4 investments cover all the possibilities. How can you cover yourself against all possible futures? Although there are millions of possibilities for the future, you don't have to worry about all of them individually. Most of what happens in the economy and the investment markets are just symptoms of the broad, underlying movements. Your portfolio needs to respond well only to those broad movements. And they fit into 4 general categories. 1. Prosperity. A period during which living standards are rising, the economy is growing, business is thriving, interest rates usually are falling, and unemployment is declining. 2. Inflation. A period when consumer prices generally are rising. They might be rising moderately, an inflation rate of 6% or so, rapidly 10% to 20% or so, as in the late 1970s, or at a runaway rate 25% or more. 3. Tight money or recession. A period during which the growth of the supply of money in circulation slows down. This leaves people with less cash than they expected to have, which usually causes a recession or period of poor economic conditions. 4. Deflation. The opposite of inflation. Consumer prices decline and the purchasing power of money grows. In the past, deflation has usually triggered a depression, a prolonged period of very bad economic conditions, as in the 1930s. Investment prices can be affected by what happens outside the financial system: wars, changes in government policies, new tax rules, civil turmoil, and other matters. But these events have a lasting effect on investments only if they push the economy from one to another of the 4 environments I've just described. The 4 economic categories are all inclusive. At any time, one of them will predominate. So if you're protected in these four situations, you're protected in all situations. Investments tied to the economy. To be protected in all circumstances, each economic environment must have at least one investment in the permanent portfolio that responds well to it. Fortunately, there are simple investments that can do that. 28 Harry Brownie / Fail-safe investing. Prosperity produces an upward market in stocks. And as prosperity causes interest rates to fall, long-term bonds go up in price. 5 Inflation weakens faith in the US dollar, the world's most popular money. As a result, many investors around the world reduce their dollar holdings and replace them with the world's second most popular form of money, gold. Once US inflation becomes more than a minor irritant, that is, once inflation reaches 6% or so, gold usually starts moving upward, and when the inflation rate gets into double digits, gold's rise accelerates. Deflation reduces the prices of most consumer goods and investments. As dollars become more valuable, interest rates fall dramatically. And as interest rates fall, bond prices go up. During the Depression of the 1930s, for example, the interest yield on US Treasury bonds fell to 2%. A drop to 2% from, say, 6%, would cause long-term bonds to double in price. Tight money is usually characterized by rising interest rates, which are bad for most investments. The only attractive investment during a recession is cash. And your cash holdings may not completely offset the losses that tight money may inflict on the rest of your portfolio. But tight money is by nature a temporary condition. Unlike prosperity, inflation, or depression, it can't go on indefinitely. Either the economy adjusts to the new level of money and returns to prosperity, or the supply of money changes, leading to inflation or a full-scale deflation. 4 investments cover all. Thus 4 investments provide coverage for all 4 economic environments. Stocks take advantage of prosperity. They tend to do poorly during periods of inflation, deflation, and tight money, but over time those periods don't undo the gains that stocks achieve during periods of prosperity. Bonds also take advantage of prosperity. In addition, they profit when interest rates collapse during a deflation. You should expect bonds to do poorly during times of inflation and tight money. Gold not only does well during times of intense inflation, it does very well. In the 1970s, gold rose 20 times over as the inflation rate soared to its peak of 15% in 1980. Gold generally does poorly during times of prosperity, tight money, and deflation. 5 Bond prices automatically rise as interest rates fall, and bond prices fall as interest rates rise, that is, bonds and interest rates move in opposite directions. A stockbroker can provide literature that explains how the bond market works. Rule 11. Build a bulletproof portfolio for protection. 29. Cash is most important during a period of tight money. Not only is it a liquid asset that can give you purchasing power when your income and investments might be ailing, but the rise in interest rates increases the return on your dollars. Cash also becomes more valuable during a deflation as prices fall. Cash is essentially neutral during a time of prosperity, and it is a loser during times of inflation. Neutrality. It might seem that a permanent portfolio containing these 4 contradictory investments would be neutralized as one element rose, another would fall, and nothing would be gained. On a day-to-day basis, that can be true. But over broad periods of time, the winning investments add more value to the portfolio than the losing investments take away. During a bull market, for example, stocks, bonds, or gold might go up 100%, or 200%, or even more. But in a bear market, a losing investment drops between say, 15% and 40%. Thus it's usual for the winner to more than cancel out the losses of the poorer investments during any particular economic environment. During the 3 years of 2000 to 2002, while the broad stock market lost close to 40%, interest rates were dropping, allowing bonds to rise and offset the losses in stocks. Meanwhile, gold rose enough to give the portfolio a decent gain. And there are more examples. During 1973 and 77, stocks generally lost about 20%, but gold rose by 153%. During 1981 and 86, gold fell 34%, while stocks rose 80%. During these periods, stocks and gold didn't cancel each other out. The winner had a bigger impact on the overall outcome than the loser did. His portfolio continued to appreciate in value no matter what the climate. The graph on the next page shows the results for the permanent portfolio for the 33 years from January 1970 through December 2002. His portfolio provided an average gain of 9.5% per year, which was 4.4% per year above the average inflation rate for the period. The years covered by the graph encompass most of the economic environments your portfolio might have to face. The 1970s were plagued with inflation. Prosperity reigned during much of the 1980s and 1990s. And there were recessions in 1970, 1973 and 1975, 1980, 1981 and 1982, 1990 and 1992, and 2001. The only economic climate not included in the period was an outright deflation, such as America suffered during the early 1930s. 6. How did the portfolio measure up to the 3 standards I have set for a portfolio? 1. Safety. The portfolio continued growing through every economic environment it faced. It even gained value in real, after inflation terms during the inflationary 1970s. With such a portfolio, you know you're safe no matter what may come. 2. Stability. A striking feature of the graph is the permanent portfolio's stability. It achieved steady growth, sheltering its owner from the extremes that most investors faced. In 33 years the portfolio lost value in only 4 years. I made the last major refinement to the permanent portfolio concept in 1987, a revision that made the portfolio simpler to set up and maintain. The graph uses the actual results for the portfolio since December 31, 1987, together with a hypothetical representation of how the same portfolio would have performed before then. Rule 11. Build a bulletproof portfolio for protection. Those losing years were ones in which most investments lost value. In particular, 1981 was a terrible year for every major investment: stocks, bonds, foreign currencies, commodities, gold, and silver, and most investors took a terrible beating that year. But still the permanent portfolio lost only 6.2%. 3 of the 4 losing years were followed by double-digit gains that overshadowed the small losses. On October 19, 1987, when the Dow Jones Industrial Average fell 22.6% in one day, the 4-investment permanent portfolio lost only 4.3% of its value. Despite the stock market crash, the portfolio finished 1987 with a gain of 5.3% for the year. And during 2000 to 2002, when the S&P 500 index lost 37% of its value even factoring in dividends, the permanent portfolio gained 9%. A table showing the year-by-year results for the portfolio is on page 81. 3. Simplicity. For most investors, this portfolio requires no more than 1 short day to set up. Thereafter, you need to monitor it only once a year merely to determine whether changes in investment prices have unbalanced the portfolio's mix of investments. The portfolio's gains were achieved without foreseeing the future, without dependence upon a guru or system to move with split-second timing from one investment to another, in fact with no switching among investments at all. Composition of the portfolio. The portfolio's effectiveness depends upon the percentage of your capital you assign to each of the 4 investments. No magic formula can tell you which distribution of investments will produce the best return over the next decade. And any attempt to be clever in assigning portions to the investments probably will do more harm than good. I prefer the simplicity of allocating 25% to each of the 4 investments. Here, for example, is the allocation to the investments with 3 possible amounts of starting capital. Each investment must have a substantial share, because the time will come when it is asked to carry the entire portfolio. And each investment will do poorly at times, so no investment should have too large a share. The portfolio's safety is assured by the contrasting qualities of the 4 investments, which assure that any event that damages one investment should be good for one or more of the others. And no investment, even at its worst, can devastate the portfolio no matter what surprises lurk around the corner. Because no investment has more than 25% of your capital. Annual checkup and rebalancing. Once established, you can pretty much forget about the permanent portfolio if you want to. The only maintenance required is to check the portfolio's makeup once a year. As investment prices change during the year, the value of the overall portfolio will change. And changing prices will cause the percentage share held by each of the 4 investments to change as well. One or more of the investments will now be worth more than 25% of the portfolio's total value. And one or more investments will be worth less than 25% of the new total value. If any of the 4 investments has become worth less than 15%, or more than 35% of the portfolio's overall value, the portfolio will be too far out of balance, and you will need to restore the original percentages. If you don't, you'll be relying too much on the most successful investment to continue being successful, and you'll be leaving some other investment with too small a share to carry the portfolio when its time comes to pull the load. As explained on page 76, you can start a permanent portfolio with as little as $1,000. For example, in the late 1970s, gold's value was rising rapidly, while the values of stocks and bonds were falling. If you hadn't restored the original balance at some point, by January 1980 gold would have comprised over 60% of the portfolio's value. During the next few months, the gold price was cut in half, which would have caused a loss of 30% of the value of an unbalanced portfolio. In addition, when stocks took off upward in 1980, they would have had too small a portion to carry the entire portfolio. However, by rebalancing the portfolio once gold was 35% of the total value, the drop in the gold price wasn't fatal and the stock portion was large enough to carry the portfolio upward. To rebalance the portfolio to its original percentages, just sell enough of the leading investments to reduce each to 25% of the total value. Use the proceeds from those sales to buy more of the investments that have fallen under 25%. This will lock in some of the profits earned by the winners, and make sure that the losers are in position to help when their time comes to shine. When you make your once-a-year check of the portfolio's value, if all 4 investments are within the 15% range, no rebalancing is necessary. During the year, if you happen to notice that there's been a big change in investment prices, you may want to check the values of the investments. Again, if any investment has strayed outside the 15% range, go ahead and rebalance the entire portfolio. Safety, stability, simplicity. What you want from a permanent portfolio is peace of mind. A permanent portfolio should let you watch the evening news or read investment publications in total serenity. No actual or threatened event should trouble you, because you'll know that your portfolio is protected against it. If someone warns about the alarming parallels between the current decade and the 1920s, you shouldn't wonder whether you need to sell all your stocks. You'll know that your permanent portfolio will take care of you even if next year turns out to be 1929 revisited. The deflation that could devastate stocks would push interest rates downward and bring big profits for your bonds. When someone claims the inflation rate is headed back to 15%, you shouldn't wonder whether to dump all your bonds. you'll know that the gain in your permanent portfolio's gold would far outweigh any losses on the bonds. When someone announces that a new debt crisis is on their way, or that another war is around the corner, or that a bull market is about to begin in stocks, bonds, or gold, you won't feel pressured to decide whether he's right. You'll know that the permanent portfolio will respond favorably to any eventuality. I can't list every potential event, so if you become concerned by any possibility, reread this chapter and you should be reassured that there's an investment in your permanent portfolio that will cover you if the worst should occur. Whatever the potential crisis or opportunity, your permanent portfolio should already be taking care of you. The portfolio can't guarantee a profit every year. No portfolio can. It won't outperform the hotshot advisor in his best year. And it won't outperform the best investment of the year. But it can give you the confidence that no crisis will destroy you, the assurance that your savings are secure and growing in all circumstances, and the knowledge that you're no longer vulnerable to the mistakes in judgment that you or the best advisor could so easily make. It's all as it should be: safe, stable, and simple.